Investors remain gripped by uncertainty as turmoil in the global banking system continues. Hello, I'm Kyle Rodder, and in this week's Investor Spotlight, we take a look at the latest developments in the banking system, discuss the possible causes and implications, and dig into 3 stocks that remain sensitive to the situation. Investors grew increasingly nervous last week as stress in the global banking system appeared to spread. After the Silicon Valley Bank collapse and the winding up of Signature Bank, which we detailed last week, signs of stress again emerged in the US and European banks. As depositors continue to flee smaller regional US banks, US Bank First Republic looked on the verge of failure, prompting authorities and the major US banking institutions to intervene by injecting additional liquidity. Of even greater concern and amidst growing and persistent rumours of financial weakness, Credit Suisse sparked fears of a Lehman-like collapse in Europe, with the Swiss National Bank providing up to 50 billion Swiss francs in emergency loans to the institution. The Credit Suisse situation stoked particular concern and amplified fears of broader contagion due to either the direct effects any collapse would have on other banks or because of other systemic vulnerabilities it might be symptomatic of. While the SNB's swift action temporarily calmed investors' nerves, it proved a band-aid solution. In developments over the weekend, UBS will take over Credit Suisse in what amounts to a forced acquisition. UBS will acquire Credit Suisse in a deal valued at $2 billion, with the Swiss National Bank guaranteeing a $100 billion line of liquidity to backstop the bank. Naturally, with a number of failures or near failures occurring in the banking system, the question becomes whether this is the beginning of a greater global financial crisis. For the time being, markets aren't flashing warning signs of an outright catastrophe. However, funding markets are showing liquidity is tighter, volatility in equity markets has increased, credit spreads are implying default risks are higher, and most remarkably, volatility in the bond market has jumped to levels not seen since the global financial crisis. As with any crisis, there remains unknowns that mean circumstances could still deteriorate from here. There are several things that could go wrong and turn this situation into a broader financial crisis, including further bank runs, financial stress from weaker bank balance sheets, or a funding freeze if banks begin to hoard capital. One underappreciated risk could also be what could be unfolding in the real economy. Financial crises typically emerge out of a credit crisis when an over-leveraged area of the economy begins to come under stress. Debt levels in the corporate sector are around record highs, with corporate debt to GDP around record levels. This raises the risk of bad loans and high default rates, which could cause or fuel greater stress in the banking system. As the ructions in the global banking system evolve, market participants are pricing in less aggressive policy from central bankers. Fed fund futures are indicating a significantly lower peak in rates, with the curve also implying that rate cuts could come by the end of the year. The US Federal Reserve meets this week with traders split on a 25 basis point hike or a hold, maybe even a possible cut to interest rates. For one, the US Federal Reserve's new lending facility, along with its traditional discount window, has provided much needed support to vulnerable institutions and the banking system at large. US banks that tapped the Fed for roughly $300 billion of short-term loans last week amidst fears of this liquidity crisis, resulting in a jump in the size of the Fed's balance sheet. The uncertainty created by the events in the global banking system has led to a broad-based decline in equities. However, owing to fears about the future of the banks, along with an aggressive repricing of interest rate expectations, gold stocks have rallied owing to a surge in the underlying gold price. Here are 3 Australian gold stocks to keep an eye on. Northern Star Resources has pushed above its 200-week moving average and broken resistance at $11.60. The next major level of resistance is around $13.30, while support could be found around the 200-week moving average at $11 per share. Newcrest Mining is on the cusp of breaking technical resistance at roughly $25.50, with the stock carving out a short-term uptrend. A break of that level could open a rally to the 200-week moving average at around $26.50. Meanwhile, support is roughly $23.30 per share. Despite the broad uptick in gold stocks, Evolution Mining has lagged the pack. It remains in a structural downtrend with momentum skewed to the downside. Thanks for watching. See you next week.